Hello everyone, welcome along to tonight's Real Estate Investor webinar on how to find affordable capital growth properties. We're joined by a very special guest, Terry Ryder from Hotspotting. You can see him on your little video screen there on the bottom right, but I'll introduce him shortly. So thank you very much for coming along. The webinar tonight's scheduled to go for about 60 minutes, and we'll talk a little bit about some of the drivers of capital growth and also go through a couple of areas that have experienced some growth due to some infrastructure or investment from government. So just hopefully this will give you a bit of an insight into the things that you can look out for to find the next area that may experience some growth. Now, if you do have any questions at all during the course of the content, just feel free to type in the little chat section there, and your questions come through. We'll answer them as we go along, but if we sort of get too bogged down, we'll make sure we'll address it at the end when we do a bit of a Q&A session. All right, so before we kick off, just a quick disclaimer. Just note that the content in the webinar is provided as information only, and it should be not taken as advice as such, and we always recommend that you do your own due diligence and ensure that you seek professional advice as well before making any decisions. So my name is Dennis Wong, welcome along, and if you're new to the real estate investor community, I hope you get a lot out of tonight's content. So I'm the product specialist here at Real Estate Investar, and I've been investing myself now for a little over 13 years, and I've been with the company for almost 6. And my very special guest, Terry Ryder, the Managing Director of Hotspotting. So welcome along, Terry. Thank you so much for joining me tonight.
Hello, Dennis. Great to be here. Looking forward to discussing real estate. Always my favourite topic to talk about.
Yeah, and we thought it'd be a good opportunity to have you along, so I really appreciate your time. And look, for those that aren't familiar with Terry and Hotspotting, we've got in a couple of slides' time. I'll get Terry to introduce him and his organisation. But for those that perhaps have come through from Hotspotting and you're tuning into your very first webinar with us, just to give you a bit of context in terms of who we are and what we're all about, we're a software platform that's been designed by property investors for property investors. And we've been around for a while now, since 2006. We are a publicly listed company here in Australia, and it's all about helping property investors like yourself be more strategic and data-driven when it comes to property investment. And there's a lot of free data out in the market on the internet. Given the the improvement of technology, a lot of the data that once was restricted to really real estate agents and property professionals or banks, it's now a lot more open, and you get a lot more of that for free. But look, there is a lot of data out there, so it's about I guess finding out what data that you should be relying on to help you make better decisions. And with Real Estate Investor, it's about trying to be a one-stop shop to give you enough to make better decisions. So we don't do it all on our own. We do have, we partner with industry leaders like CoreLogic, Pricefinder, Domain, Xero, Washington Brown, who specialize in depreciation reports, to try and provide deep and a rich set of resources for property investors like yourselves. Now, Terry, I thought this would be a good opportunity just to introduce yourself. So if you just want to give us a little bit of an insight in terms of who you are and what Hotspotting is all about.
Yeah, thanks, Dennis. I've been around residential property research and writing for over 30 years. I started out as a newspaper journalist specialising in residential property, working for publications like the Courier Mail, based in Brisbane, and later the Australian Financial Review, before becoming a consultant to the industry. And in 2006, I launched the hotspotting.com.au website, which was essentially set up to help property investors find the best places to buy. We specialise in seeking to identify the future growth areas, the future outer performers or hotspots, before prices grow, which is a allowing investors to buy at the optimum time before prices rise in areas where confident prices will rise. So that's essentially what we do. We provide a range of reports covering the whole nation, identifying the best places to buy in specific cities, specific states, also national reports. And we also have a range of what we call B2B products, products that we help real estate businesses with, real estate agencies, buyers agencies, marketing companies, developers, etc. Very often it's writing custom-built reports on specific locations, which is really what we specialise in. It's gathering together all the information that's out there and putting it into a form that's easy to read and understand for a range of real estate consumers. So that's, in a nutshell, what we do.
Yeah, fantastic. And look, I had the privilege of being exposed to some of these reports a couple of years ago. And look, for everyone tonight, a little bit on towards the end of the webinar, we'll just go through just some of the bits of research that Terry does put together in these reports, just to show you how in-depth they really are. So look, before we kick off into the content, I thought it'd be a good opportunity just to get an idea on the audience that we have tuning in. So I'm just going to launch two very quick polls, and look, it'll help Terry and myself perhaps tailor this slightly as well. So, if we do have a lot of beginners out there, perhaps we might take time to explain a few of the concepts a little bit more. But if we have more experienced ones, then we can skip those. So I'll just go to the poll. So the first question is, when are you planning to purchase your next property? So just give us an idea in terms of when you're ready. So I've just launched that. And if you just click on the screen, whether you're looking at buying right now, perhaps you're finance ready, hoping to get something before Christmas, or perhaps you are you looking more longer term, you're looking 4 to 6 months, or perhaps even towards the new financial year, July next year. Or maybe you're not looking at buying at all and you're just educating yourself and getting yourself as much data and information as possible before you pull the trigger. All right, so we're getting some people voting already. Fantastic. All right. So it looks like we've got a few, about 42% looking at buying right now. So I'm assuming you're all market ready. So hopefully this webinar will give you a bit of insight and perhaps maybe validate some of your own research that you've done, or perhaps that you're not sure where to look at. This may give you some ideas in terms of direction. 4 to 6 months, about 21%, 6 months plus 12%. Those looking at more than a year, just a little bit over just 20%, and only 9%, about 8% just educating. Okay, fantastic. Appreciate your participation there. So I'm just going to launch one more poll. And this is about how many properties do you currently own. So let's just come in here and I'll publish that. So I think, Terry, I think in a lot of the research, the average investor in Australia owns 1 or maybe 2 investment properties.
The official figures from the Australian Taxation Office show that 75% of people with investment properties own 1 or 2.
Yep.
So that's very much the majority. And those that own 5 or more are less than 1% of the total, which means that the vast majority of people out there just own 1 or maybe 2 properties. It tends to put the light of some of the rhetoric we saw in the recent federal election, where the Labor Party was trying to characterise the typical property investor who's out there looking for their 20th or 30th property and being propped up by negative gearing tax benefits. So it was very much a million light years from the true situation, which is that less than 1% own 5 or more properties.
Yeah, and look, the numbers sort of suggest just from the audience as well. So we've got 9% with 0 properties, and then 39% have 1. And then we've got 45% with 2 to 4 properties. So I probably should have broken that up to 2 and then 3 to 5. And then we've only got 5% with 5 or more properties and 0 with 10 plus. So it sort of does reflect the stats that the ABS published. All right, excellent, guys. All right, so I'll skip through probably a couple of these introductory, given that most people here have a property, but look, in terms of capital growth, what is it? I guess for the person that's just starting out, it's it's when there's an increase in the value of your property. You know, your property's increased in value from the price that you purchased it at. And essentially, there's two ways that a property can appreciate in value. One is I guess what most people do, buy, hold, and forget. If you're looking long term, is just natural growth. You're just waiting for the market to increase, which can take a long time, and there's definitely no guarantee that that will happen. Some people might get lucky. I guess if you buy at the right time of the market, which some people I guess did in Sydney a few years back, they would have seen some significant growth if they bought in the right area at the right time.
Well, certainly, Dennis, our contact with real estate consumers shows that increasingly property investors are looking for a little bit more than just passive investment, which is, you know, the natural growth that you're articulating there, buy and hold and wait for the market to increase. More and more investors we find are looking for ways to accelerate the process. So they're looking for property where you can perhaps value add and you can manufacture growth, as you're suggesting, through, building an additional dwelling or even a granny flat on the existing property, or subdivide it, creating 2 or 3 properties out of one property, or doing renovations. I think more and more investors are really looking for those opportunities.
Yeah, we've seen that interest sort of build up over the last couple of years during my time here. You know, and you know what Terry alluded there is, you know, some people call it manufacturing the growth. You know, you're forcing that capital growth of that property or that site by doing things like renovations or subdividing and developing, and which we've seen a lot of, especially in Melbourne, where, you know, people are buying the 3-4 bed house and knocking that down and putting 2-3 townhouses on them, which we're seeing a lot more and more of. So it is a faster option to increase growth. You're not relying on the market, and you know, you do have data. Well, depending on the area, you should be able to get data on to be able to see how likely or risky that strategy is going to be by looking at comparables. So, and that's what that's all about, is looking at things to support whether that strategy is going to work in that area. Now, one way of investing is buying in a blue chip suburb. So what are they? Well, essentially the suburbs or areas that are well located, they're established. There's generally not a lot of free land available, and they're consistently going to return steady growth over time. Now, they still experience flat and downturns, so there's not always, every year they're going to be, 5%, 6% growth, but they generally do will always recover. An example is, inner city suburbs, and don't get me wrong, not all inner city suburbs are maybe blue chip. There's a lot of different other factors that obviously will contribute to capital growth. So, it's not just that one single factor being close to the city, but properties in these suburbs are generally going to be priced in the higher end of the market. So not everyone's going to be able to afford to buy in areas like, if we look at Brisbane in Hamilton, considered quite a blue chip suburb. It's, 5 Ks from the city, CBD of Brisbane. And if you look at the graph on the right there in terms of house price, median house price, you can see that, over time, it's back in the early 2000s, median house price is about 300,000. Hit a peak in around 2008, bit of a sharp drop, but always recovers, and you can see now, about a little bit over 1.6 million in terms of median house price. So some capital growth drivers, Terry, I think, I might get some of your input into here, and I guess these are some of the things that investors should be looking out for. And again, it's not just about one single factor. You need to do thorough research on all of these different factors to help you predict, I guess, whether a property that you're going to be targeting or an area you're targeting is going to give you that capital growth over time. So obviously, number one being demand exceeding supply, low days on market, which generally indicates that properties are selling quickly because there is a lot of buyers in the market. They're putting in good offers and sellers are accepting. Low vacancy rates, obviously attractive to tenants, because potentially that may mean higher rental yields and there's not much stock available. Low to no vendor discounting. I think we're sort of starting to see that in some areas now in Melbourne and Sydney, where vendors were having to discount to try and attract buyers. But if you can obviously see an area where it's generally not much vendor discounting, There's generally indicates there's good demand, high auction clearance rates, low supply of vacant land for development.
I think we've seen, Dennis, that first factor you mentioned, demand exceeds supply, is very much a factor in both the Sydney and Melbourne markets at the moment. We've seen, obviously, an uptick in demand from buyers, particularly since, well, there's been what I call a series of fortunate events, which started with the federal election result in May, APRA changes, interest rate cuts, tax cuts, increased insistence for first home buyers, which has been now legislated federally. But vendors have been surprisingly reluctant to come to the party, so we still have low supply, low levels of listings relative to what we would normally expect. So demand high, supply low, also at a time when construction of new dwellings, particularly apartments, has fallen away quite dramatically. So we certainly have that factor very much in play in the two big cities at the moment: high demand, low supply. The other factor that you referred to, low vacancy rates, I think that's a very good leading indicator. What the research tends to show is that quite often before markets have a price boom, they will have a period where vacancies are low and rentals have grown quite a lot, but prices haven't. And then prices will subsequently follow that lead from the rental market. We saw that in Sydney prior to getting on its boom path around 2013. There were a couple of years of strong rental growth, but not much in the way of price growth. Hobart's another example of that, where vacancies have been very low for a long time and still are, about 0.5, 0.6%, according to the figures that we see. And that was very much a leader of the price growth that we've seen in Hobart in the last couple of years.
Yeah, look, and one of the points that you touched on there is the construction. I saw some numbers that were published recently, and they were significantly lower than what in terms of apartment approvals. I think were been the lowest that they've been for a very long time. So some of the other things that you should be looking out for is future development or infrastructure or amenities. They're generally going to be, especially if they're going to be creating long-term jobs. And big picture photo here of the proposed $1.5 billion new Footscray Hospital, which is going to be opening in a couple of years' time. That's just going to create more jobs, and people are going to want to live around that area. Demographics, so really important, looking at ABS stats, increase in population numbers, income levels. Is there a high percentage of owner-occupiers? That's usually a driver of growth. They generally tend to buy based on emotion because they want to be there in an area for a particular reason, and it's usually things because of schools or employment. So you want to look at, and you can see there's a few points there when it comes to location. If you're close proximity to CBD, not necessarily CBD though, but I guess that's in there because that's a major employment hub generally. But we are starting to see more regional employment hubs pop up. Public transport, schools, shopping centres, cafes, entertainment, medical. They're a lot of the key infrastructure and amenities that people want to be around. They don't want to be sitting in traffic for a very long time to get to those places.
Yeah, Dennis, I think a couple of points that are worth elaborating on. We'll probably talk more about infrastructure as we go through the presentation, but I think it's absolutely pivotal. And I think what we believe to be true at Hotspotting is that real estate markets are very locally based. They essentially arrive at what is happening in local economies. It's not so much national factors such as the level of interest rates or tax benefits like negative gearing or what's happening with the national economy. It's very much about the local economies, which explains why we have so many regional differences over the last several years. While Sydney and Melbourne were having their boom, Perth and Darwin were going backwards with their pricing, and cities like Brisbane, Adelaide and Canberra were having only very minor growth, and a whole range of different scenarios playing out across regional Australia as well. And the explanation for those differences is that real estate markets very much arise out of what's happening in local economies, and we have very major differences from one state to the next, from one city to the next. Another point on your list on the screen at the moment, employment hubs, I think that's a very important one. Proximity to employment zones is very important, and it's important to understand that while the CBDs in our major city are major employment hubs, the vast majority of jobs in any city are actually outside the CBD. They're in a series of suburban hubs, which might be, for example, around the major airport in our major cities. There's massive jobs nodes in the commercial industrial areas that spring up around major airports,
Yes.
which is why the new airport in Western Sydney is considered to be so pivotal for property markets out in Western Sydney, because it's going to create a massive employment zone. So it's definitely something to look for. The research shows that people, if they can, would like to live close to where they work. So buying close to major employment hubs, keeping in mind again that many of them are out in suburban areas, is a very important factor to keep in mind when you're selecting a place to buy.
Yeah. Yeah, definitely. And look, and this is the thing about trying to find untapped affordable growth areas. So, you know, by the time it hits the media, it's probably too late. You know, when you're hearing about hotspots and people talking about, you know, 20% growth, and it's too late. And it's about trying to identify these areas of growth before it becomes too expensive. And we've got a couple of...
Mainstream media is very unhelpful to property buyers of all sorts, Dennis. Essentially, they write a lot of stories about what's happened with median prices in, say, the last quarter or the last 12 months. And that essentially is telling people where they should have bought perhaps a year ago or a couple of years ago. Whereas what people are really looking for is indicators of where they should buy now before the growth has happened.
Yes.
So that's where research services like ours and like yours are so important to property investors, because it provides the data that gives the clues to where the next growth areas are going to happen before they happen. And that's really valuable information to property investors and buyers of other sorts as well.
Yeah, and so some of those drivers there, guys, that we listed before, you know, that's not a full comprehensive list, but they definitely are the key to help you determine whether it's likely going to go through that type of growth. And you know, that third point there, you know, capital growth follows rental yields. So Terry touched on that a couple of slides prior. Now, it's not always going to happen, but again, you know, if an area is providing high rental yields for investors, other investors are going to start to take notice that, okay, well, you know, there's 5-6% yields here, that's quite affordable. They're going to then start wanting to buy in that area, and that's what potentially can drive price up there. But then you need to look at other factors as well that we talked about, like infrastructure and employment hubs, to see why is it that yields are high there, and that it's not just based on one thing, like if it's a mining town, for example, which can be quite risky. Looking at
Sorry, Dennis, the last point you've got on the screen there, suburbs with major hospitals and universities. What we find is that in our major cities, and also in regional cities as well, hospitals and universities often cluster together. There are often precincts in our major cities where there's not just the university, but there's maybe two, and there's also hospitals as well. So Parkville, Carlton area just north of the CBD in Melbourne is a huge zone where there's two very large university campuses plus a couple of major hospitals. In Adelaide, down in the city of Marion, there's Flinders University campus as well as the Flinders Medical Precinct. So there's that clustering together. And when you've got that in a local market, it creates enormous demand firstly for rentals, but also for people to buy real estate. Big job zones, and also lots of people going there as students, etc., or as workers, and therefore demand for rentals in those areas tends to be well above average, and vacancies do tend to be very low. So it's a market to look for, I think, that clustering of medical and education facilities.
Yeah, look, definitely agree. And look, these couple of next examples will, you know, sort of show or highlight some of this data. And you know, if you were looking, you know, when these hospitals open. So, you know, this first example here is based on the Gold Coast in Southport. So the original hospital was actually in Southport already, but it was more towards the CBD. So if we look at the map there, sort of the right-hand side there where the Southport private hospital is, the original Gold Coast hospital was there, but then they moved it right in the middle there, surrounded by residential suburbs like Parkwood, Labrador, and Mollendina. And like Terry said, there's a university directly opposite it. Private hospital opened up as well, so it is a major hub. And so this university hospital opened up in September 2013, cost of about $1.8 billion. So if we keep that in mind, 2013 is when it opened, or when it completed and then opened shortly after. If we look at Southport, if we look at the median house price, look at 2013, prices start to increase, and it's been increasing. Obviously, it's flattened out a bit now, and it's a bit of a correction, but a couple of years of growth there since that that hospital opened. We look at the other suburbs, Labrador. Not much been happening, but then 2013. Again, demand then starts to increase, and then over the last couple of years has had some steady growth in terms of house prices. Parkwood, which is a bit of an older suburb, again, 2013, flat, nothing happening, but as soon as the hospital opened, you can see that growth. And if you look at all the house prices, median house prices before the hospital opened, they're around that 450K mark. Now we're looking more up to 650K. And then if we go to Mullendina, which is a little bit further south, again, similar story, a little bit over 450K median house price, and now we're looking at 600K a couple of years later. So we're looking at demographics. So, with CoreLogic RP data, some of the reports you can pull, takes the census data. We're looking at things like, your owner-occupier versus renters. So we'll just use Parkwood as an example, which is directly opposite the hospital, pretty large area. A little bit over 8,000 in terms of populations, increased 3% over the last 5 years. And you can get a lot of that stats, incomes and stuff like that from these reports. If we go direct to the census, have a look at that. Between 2006 and 2011, the population numbers actually went backwards a little bit. But then 2016, so after it opened in 2013, it's jumped up. Look at the median weekly household income, $1,200 back in 2006 in terms of median weekly household income. And a couple of years ago, up to $1,600. Median weekly rents, again, like Terry mentioned, the demand for rentals from students or young graduates who are now just working at the hospital. There's demand for wanting to rent close, and the industry of employment. 2006, 2011 was more sort of hospitality, and then 2016, no surprise there, it's now hospitals is the top industry of employment in the area.
Yeah.
I might get you maybe talk a little bit about up Sunshine Coast, Terry. So similar story, $1.8 billion, and a few years later, officially opened in April 2017. We've got the Sunshine Coast Uni Hospital right in the middle there.
Different types of infrastructure have different impacts on property markets, and the ones we particularly like are the ones we're talking about, hospitals and universities. If you build transport infrastructure can be very influential, but it's a type of infrastructure where there's many thousands of jobs in actually building it, but once it's finished, there's not too many jobs in running it. Hospitals and universities are different. Lots of jobs in actually constructing the facilities, but when they're finished and actually operating, there's actually more jobs in operating them than constructing them. So that type of infrastructure has a lasting impact on property markets because it creates a massive jobs node and it creates big demand for real estate in the vicinity. And one of the factors is that when you've got a major hospital, it brings in new people to work in that hospital. Sometimes there's thousands of jobs in a major new hospital facility, and many of them are highly paid medical professionals, specialists. Yeah. And so people with those high incomes in particular can give a boost to median prices in an area. And one of the things we've seen on the Sunshine Coast is the top end of the Sunshine Coast market in particular has moved. So we've seen the Noosa precinct, suburbs like Noosa, Noosaville, Sunshine Beach and Sunrise Beach have big increases in the last couple of years in their median prices, both for apartments and for houses. And we think that's directly related to, well, not just the hospital, lots of different things going on the Sunshine Coast, massive infrastructure spend happening there, but that new hospital precinct is very influential. And it's not just the university hospital that we're featuring in the slide on the screen, 1.8 billion. Other things of a medical nature have sprung up around it. So there's a new private hospital there as well. And it's still a work in progress. Ultimately, this is a $5 billion precinct. So it's created a whole new industry for the Sunshine Coast, which in the past has had an economy too heavily reliant on tourism, which is a little bit fragile and fickle. Now, new things will be creating through a $20 billion infrastructure spend. We're seeing the airport going international. We're seeing a new CBD created from the ground up in Maroochydore on 53 hectares that's available, and that's starting to happen now. And this medical precinct is still a work in progress. There's more stages to come, and ultimately be a $5 billion industry based around the university hospital. So hugely influential for that economy, and out of that, the property market. So we're seeing big price rises at the top end. And I think it's part of a process that's going to make this market, this economy, and its property market very, very strong moving forward from this point.
Yeah, look, this is probably quite a unique one as well, because if you have a look, a lot of these suburbs here are, are beachfront suburbs as well. So, for doctors and medical practitioners that perhaps can afford to buy that in the higher end now, not only are close to work, but also close in terms of lifestyle to the beach. Yep, you go, Terry.
Many of the suburbs, this is like in the southern part of the Sunshine Coast coastal strip, south of Maroochydore and Mooloolaba, and there's a canal suburb called Minyama, which is one of the top end suburbs, median price well above $1 million there, and that's had some uplift. But many of the suburbs closest to this precinct are actually a lot more affordable, and particularly the apartment market. Not far, a little bit further south, we've got the Caloundra precinct, which has been very underrated, but has been increasingly gentrified, and has some wonderful beaches, affordable real estate, particularly apartments. So it's a sort of market that even first home buyers can get into, particularly the apartment market, be close to this new medical precinct, which has become one of the very big job nodes of the Sunshine Coast, which overall is a regional city that's creating jobs and growing its economy at rates much faster than national averages, and I think that's going to continue.
Yeah, look, I just looked up some numbers there, Terry. You're right. So over the coming years, at the moment, the hospital has 450 beds, but over the coming years, they've got the capacity to increase that to 738 beds by 2021. And then they've even got the ability to then expand that further to 900 beds beyond 2021. So obviously, more beds means they're going to need to employ more people to be able to service more patients.
And in addition to that, you've got the private hospital that's also there, and also there's specialist medical clinics that have also been built because they want to be close to the university hospital. And the name Sunshine Coast University Hospital is important too, because the Sunshine Coast has a very important and forever growing university. The Sunshine Coast University is another growth industry for the Sunshine Coast, and it's not too far away from the location of this hospital, complete in 2017. So again, you've got that interlinking of medical and health facilities that we see in other cities around Australia. It's very much evident here on the Sunshine Coast, and that's becoming an important part of the growing and diversification of this economy, which I think is really important because previously, as I said before, too reliant on tourism, which is quite kind of a fickle industry. It's very prone to bad weather or people not being confident about their jobs. But now that you have these additional elements to the city's economy, it's becoming much stronger. And I think it's just going to go forward from there, helped by other factors like the creation of the new CBD, the upgrade of the airport to international status, the new international subsea cable, which will give the Sunshine Coast the fastest internet links to Asia from anywhere on the eastern coast of Australia.
That got announced last year, didn't it, or early this year?
Yeah, I mean, there's so many things happening in this economy. I wrote a major report recently in which I came to the conclusion that I think the Sunshine Coast economy, the story there is the most compelling economic story anywhere in Australia, and out of that is coming a very, very strong property market. So one that's well worthy of consideration, I think, by property investors around Australia.
Yeah, so look, similar to the Southport story, if we have a look at those 4 suburbs that I've highlighted there, they're quite close proximity to the University Hospital. If we look at Warana, look at again, 2017, once it opened, there was a bit of a dip, but then median house prices increased, and you can see the green bars there is the number of sales. So the number of listings is reduced, but prices are still increasing. Arena, again, 2013, price jumps, and we look, median house price was about 650. Now we're looking closer to the 900K mark. Wertala, hope I pronounced that correctly. Again, similar story. Wertala, yep, similar story. 500, 550, affordable sort of area. Now it's coming close to the 700K mark. Currimundi, again, mid 500s, bit of a dip there, but they all seem to have the similar growth lines post the opening of the hospital. Yeah. So where do you go look for, where do you look for these projects? Where do we look for these, where the spending is going to happen from government? So every state, and even at a national level, they've got their own website. So here's an example of the Queensland project site that you can go to. And again, just recently, it's been announced that stage 3A of the Gold Coast tram line is going to be built. They're going to start, I think, digging or start construction early in the new year. So again, it's going to open up access from Broadbeach to Burleigh Heads. Burleigh Heads is a major tourist spot as well as a great spot for locals to hang out. But what about all those little areas in between? Miami, are they going to start to take off even more than before? Here's one for Victoria. Victoria's Big Build. You can access all this information is for free. But we'll talk a little bit about some of the work that Terry does, which consolidates all this information in one nice little report. But again, you can jump on there and have a look, and every state will have its own site. So what do you do about that? So once you find a potential area where there is infrastructure going in, and there's commitment from the government, there's funding, it's started, how do you find these deals, or how do you find opportunities? And this is where the Real Estate Investor platform can help, where you've got the ability to narrow it down by a strategy. So if you're not just relying on natural growth and you want to renovate, or you want to see if there's an opportunity to develop or subdivide, then you can find these listings quite quickly using the investor platform, because we actually look at 20 property portals and we bring all those listings into our system, and we can look at keywords where you can quickly identify those opportunities. So there's two ways you can go about it. So option one is if you're one of those investors that are in the 5+ group, and you've got a much bigger borrowing capacity, then we do actually have a keyword strategy called capital growth, but it is looking for those blue chip types of suburbs, because we're looking at keywords like city views, waterfront, water views. They're going to always grow over time. But if you're just starting out and you want to look for an affordable suburb where there is the potential for capital growth, then this is where option 2 can help, where you can actually do a radius search. And I've got an example here of another, again, a university that we've been talking, University of the Sunshine Coast, but it's not actually based on the Sunshine Coast. It's actually based out of the Moreton Bay region, and out at a suburb called Petrie. They've already started works on it. I think it's due to open next year, isn't it, Terry? Well, the first stage anyway.
Yeah, they're aiming to have it ready for the start of the university year next year, and it's very much under construction. I think it's a game changer for that area. It's already a good solid area, and it's sort of a place that attracts good demand because it's affordable. You've got Petrie and Launton, 2 neighbouring suburbs, which have what I like to call good real estate bones. They've got all the basic things that people look for: affordable real estate, lots of schools. They're on the train line connecting to central Brisbane or going north to the Sunshine Coast. Great retail offering. There are lots of sort of major shopping centres and other forms of retail. Also lots of green space there. So it's quite a good lifestyle area for people on a budget. But this coming in the midst of those suburbs where median house prices are a sort of low to mid 400,000s, I think. This new university campus is going to have the impact we've seen happen in some of the other places we've talked about. It's just going to create a huge jobs node. So a lot of people are going to be working there. And as we know, people like to live as close as they can to where they work, but also, of course, the student factor. People studying there are going to want to be renting accommodation as close as they can to that facility. So it's going to be a massive factor in a market that already ticks a lot of boxes, I think, particularly just basic amenities and infrastructure that already exist, and affordability.
Yeah, I think it's not too far away from the North Lakes area where there's the massive Westfield that shopping centre that opened there, Costco's out there, IKEA's out there. I mean, that
Yeah,
opened up a couple of years ago, I think, and it did wonders for that
yeah.
area.
Yeah, that's right. Well, North Lakes has introduced a lot of infrastructure into the area. So, you've got, big shopping centre, but also the bulky goods stuff. The IKEA superstore, there's not very many of those in Australia, but this location has one nearby.
Mm.
Libraries, all those sort of basic community facilities that are important to people. So that's nearby. But the suburbs of Launton and Peachtree themselves also have very good infrastructure, particularly retail, schools,
Yep.
and the commuter train station. That's an important factor as well. So if you own real estate that's within easy striking distance of all of that, then you've got a lot of drivers that are going to push demand and therefore capital growth over time.
Yeah, and if we ever look at the Peachtree median house price at the moment, 450K. So very, very affordable. I think some of the blocks are a lot larger than your inner city Brisbane blocks. We're probably talking more about 600, 700 square meters compared to your, 405 square meter blocks. And then I'm guessing it's probably a matter of time before councils then perhaps start looking at zoning and seeing whether you can increase density in some of the pockets of these suburbs. So 450K at the moment. Obviously, uni's not open yet, so there's no need for people to start looking and moving in there. But we're not very far off 2020 now. So I think over the next 10 years, the uni will be able to accommodate up to 10,000 students.
Yeah. And there was some media just in the last couple of weeks, Dennis, about that facility, and it sounds like, according to the political rhetoric, at least, that it's going to be an even bigger and more important facility than originally proposed. The sort of rhetoric around turning into a kind of a Silicon Valley type centre. Remains to be seen how that will evolve, but certainly it's going to be a very, very important part of the economic fabric of that location, and it's going to have a big impact on real estate in the immediate vicinity.
Yeah, definitely. And so, knowing that that's happening at the moment, you can start potentially, if all those other variables, if all those other factors make sense, and, you can identify a site by doing a radius search around Peachtree. We can do a 10-kilometre search around 4502, being the postcode of Peachtree. You can also then add things like suburb rental yield. So perhaps look at some of those neighbouring suburbs. Are they high rental yields at the moment? Look at vacancy rates. Try and narrow down your search to areas that are already quite tightly held. Once a listing pops up, so here's one in Strathpine. Asking price $319. Very affordable, 673 square metre block. Like I said, so much bigger than the average Brisbane block. You get a lot of stats around it. So this is now where all this data comes in to help you establish, okay, what's this property really worth right now? Is there the potential to renovate if that's the strategy? We've got median listing prices. You can see the median weekly rent for a 3-bed house in this suburb. The graph will give you some indication of what's happening in growth for 3-bed houses over the last couple of years. And you can see in this particular case, it's a renovate and profit. So that's the keywords used by the listing agent. And then you got your suburb stats on Strathpine as a whole. So we can see 1.8% vacancy rate, average days on market 78, 95 current listings. And then you can also quickly see zoning, land use, and any overlays. In this case, there's not available, but overlays will usually refer to things like if it's there's a character overlay or a heritage overlay, flooding, bushfire, things like that. But the zoning here, general residential, next generation neighbourhood. So to me, that sounds like there may be some rejuvenation that might be occurring. That maybe there's a big plan in place from local council to change that area up. So you can get all those stats just from the listing to help you make a decision on whether it's worth pursuing further. So if we look at some of the neighbouring suburbs again. Here we go, Strathpine. So this is the property that that came up as a result. We've got median price of just under 450. And we can sort of see, there's been sort of steady, slow growth, nothing sort of, no steep increases or drops. But once the university opens, is that going to change? Launton, one of the suburbs that Terry just mentioned, again, low 400s, median house price. Kalanga, 400. So I'm just going to run just a quick search just to show you that live. What does that look like? How do you sort of narrow it down further? So let me just switch across. So instead of going on Domain or realestate.com and manually going through each listing one by one and spending hours and hours of research time, you can actually just speed up the process by looking at keywords, using filtering by vacancy rates. It's not about the pretty pictures and trying to sell the house because it's got the media room or the outdoor deck. It's about looking at the numbers. So, all right. So we've had a lot of members, they've come back and said that, they've reduced their time by half when it comes to searching. And then, once you find your shortlist your properties, that's when you can then spend more of your time actually doing the research, jumping onto your RP data and having a quick look to see, okay, how long's it been on the market? Can you, what are the average days on market? Is a 3-bed more popular with 4-bed than 4-bed houses? Having a look at those numbers. So we'll look. So we'll go. Let's do 15 kilometers, and we'll do that radius of 4502. So I'll go out a little bit more. So keyword strategy. This is where you can specify what it is that you're focusing on, what's relevant to you. So if you're a more experienced investor and you're just looking for something that's going to give you capital growth over a long time because you don't want to do a renovation or go through subdivisions and talk to council, then set it on capital growth. Try and find a property that has a waterfront. Otherwise, if you're looking for something to renovate, you can pick that as a strategy. And then the keywords are we automatically hard code things like renovators delight, cosmetic, add value. You can then combine that with other filters. So if I expand it all up, there's not actually a lot of filters that you need to have to worry about. It's just about understanding which filters are going to be relevant for what strategy. So let's just say we don't want to touch anything that's in an apartment complex or a townhouse complex. We're doing houses. Now we're renovating, so we want to find something at least something priced below the median of that area. So we can say set it to maximum 80%. So if the median, I'll just use some nice round figures. If the median listing price for a 4-bed house is $100,000, at 80%, it means my search results will only show me any properties listed at $80,000 or less. So you've got that $20,000 price gap. I'll combine that with vacancy rate. So let's set it, say, nothing more than 1.5%. And I think most property professionals say if you can find anything between 2 and 3, that's usually quite a balanced market. Anything lower, the better. So you can see, based off, I've used a few filters here. I've got 7 matching properties. This one here is from Domain. There's no address. They've just listed as Eaton Hills, the suburb. Bray Park, asking $289. Very, very affordable. 607 square meter block. 70.5% of the median listing price. Because at the moment, 3-bed houses, $410 is the median listing price, and we've got a median weekly rent of $375, 4.8% gross yield. So then you can open up the ad. So again, more data. Okay, there's the keyword renovations popped up. We do provide you links to the local council website, infrastructure, so you can go straight there and do some of that research if you're not familiar with it. Vacancy rate, days on market. You've got your zoning here, overlays, land use potential. So in this case here, it's saying you might be able to put a duplex or might be able to put some townhouses on there. Always got to double check with council. And then you get an idea on the breakup of that population of the area too. So we can see that, 47% are looking at buying, 25% are fully owned, and you've got a 28% rental market. And you can quickly see, if you're developing or if you're renovating and then looking to sell, you can see the competition, what else is on the market. And you can see it by price range, by property type, and also look at rentals as well. So it just puts everything in the one spot so you can find them quickly and then hop on over to do your due diligence in RP data to look at the actual numbers and see if it's, okay, is it fairly priced? All right, so let me switch back. So it's all about the tools are built for investors that are doing it themselves. Now, obviously, you saw a few of those links where you can go to the council website, infrastructure website. You do a lot of that research. What's the government planning next? There are a few different websites that you have to go to, but I guess this is where hotspotting reports that Terry Ryder produce comes in. And Terry, I might maybe just get you to talk a little bit about, this is just some snippets from an old report that you released last year, but do you want to perhaps just talk about, I guess, what you've included and, how long actually, the time it takes you to, I guess, put all this together?
Yeah, well, we have a daily research exercise where certain staff members are scouring various sources, including media online, looking for indicators. The thing we look for specific things to identify areas, to put them on our radar screen as potential hotspots that we might include in a report like this. I think the cover you had in the previous slides was our national top 10 best buys report. So the locations that are included in that report, which we update 3 times a year, are those the places that we think are the best 10 locations for people. We do emphasise areas that are affordable to most people. So we think it's not much point in advocating areas like the Tracts and the Wallaras of this world, where the vast majority of people can't afford to buy. But Bendigo is on screen. That's a great example of a market that offers a lot to the vast majority of investors because it's very affordable. You can buy good property in the 300,000s there. The vacancy rates are very low. The rental market is strong. You can get good rental returns there. And there's also lots of potential in that market to find property that has value-added potential in certain zonings. In certain areas, you can buy property on large blocks, 1,000 square metres or more, which can be subdivided into 2 or 3 blocks. So we tend to emphasise in these reports the underlying economy because we think that's really important. So we talk about the makeup of the economy. We like locations that have economic diversity. We talk about demographic and population factors. Then we talk about the property market. And I think perhaps the most important segment of these location reports that make up a report like Top 10 Best Buys is the future prospects, that segment, and that includes the table of upcoming developments that you're showing on the screen now. So we have all the major projects that are likely to create jobs in the area, that are likely to create economic activity and increase the amenity. So what's on screen, different types of infrastructure, education infrastructure, transport infrastructure, very important, commercial developments, residential developments. They all play a part. And we have a location like Bendigo where there's a lot of this activity going on. It gives you confidence in the future of that city, which, for example, recently completed as a $700 million hospital facility for Bendigo. The fact that the state government would spend that level of investment in Bendigo is an indication of how important they see it in the future of the state of Victoria. And it certainly is a very important regional city. It's well connected to the capital city. It's got a strong economy in its own right. And for investors, very affordable, good rental yields, low vacancies. So it's one to consider. So all of those factors are included in a typical location report. And a top 10 report comprises 10 location reports. We choose the 10 locations and we include our standard location reports for each of those, roughly in order of the priority as we see them. We rank them from 1 to 10, although, it would differ from one investor to the next depending on their price range, what they already own, what their strategy is. But we do list those 10 locations in order of ranking as we see them. Bearing in mind that this is a report from last year, showing some of the key projects that were on the books, whether proposed, under construction or recently completed in that market. And what we quite often do is we get out a calculator and add up the total of all these various projects, infrastructure projects, property developments, and sometimes in the case of the Sunshine Coast, for example, you get a figure that's over $20 billion, which is massive for a regional city of that size. For Townsville is another example where it's even more than that. And that's when you start to think that here's a market that's going to go places in the short to medium term because there's just so much investment going into infrastructure or property developments that it's just got to be a generator of a strong economy and therefore demand for real estate.
Fantastic. All right, thanks for the feedback, guys. So look, the session has been recorded, so you'll actually get emailed the copy. So hopefully you'll be able to re-watch those bits if you did miss any. So there is a special offer you're running at the moment, isn't there, Terry, in terms of some of your reports? So I guess for those that don't want to spend the time or don't have the time to actually go to all these different sites to try and find out what is actually happening there, you've actually done all the hard work and you've got an offer on at the moment.
And that's very much what it's about, Dennis. People are time poor typically, and we try to make it easy for them because there's so much information out there. All the information a property investor could ever want is out there, but it takes a lot of time to access it. And then if you don't have experience, you can't necessarily make sense of it. So our reports bring it all together and put it in a readable form that makes sense of it and takes the legwork out of it for property investors. Now, what we know to be true, and I'm sure everybody has observed it in real estate research over the last, say, 6 months, has been quite a big change in the overall climate nationally for real estate. The first half of the year, there was a lot of negativity. But since the federal election result, there's been a series of events which have increased confidence. And we've got to the point now where we're seeing some strong uprise, some strong uplift in major markets, Sydney, Melbourne. It's starting to spread to other major cities. And there are also regional centres that are also got very strong demand in their markets with prices rising. So we thought it was an opportune time to have a bundle, a special offer that combines our three most popular reports into one bundle. So we've got our national top 10 best buyers reports, our top 10 regional hotspots reports, which we think is very important because regional hotspots provide what we call a win-win-win situation for people, very affordable prices relative to the capital cities, much better rental yields usually. And if you buy in the right places, really good prospects for capital growth. So I think more people should be thinking regionally in their search for future growth markets to buy in. And the Price Predictor Index, which is another of our very popular reports, which we publish every quarter as a leading indicator, looking at sales volumes in particular where prices are going to grow. So we've bundled them all up into a bundle where if you bought them individually, you'd pay $561, but if you buy the three as a bundle, it costs $297. So yes, saving of almost 50% if you grab that bundle. And if you grab it and have a look at it, you're going to get some really good leads onto where to buy in the current climate where we've got very cheap finance, easier finance, markets rising, confidence rising. Very good time to be considering getting into the market as investors. And I think your poll at the beginning, Dennis, indicated that the biggest quartile or the biggest section of your poll with people are wanting to buy now. And I understand that because it really is an opportunity with very cheap finance and markets coming out of a slump and starting to rise. It's opportune. And that's why we timed this particular bundle for now to try and help people make some choices.
Yeah, look, and some of the economists are saying that, if I guess spending over the Christmas New Year period is not going to be strong, that first month of the when the RBA meet, that the interest rates are probably going to drop again. So it is definitely a good time in terms of cheap finance. And so I've put the link up on there, so you can see down there. Otherwise, I've launched the deal as well onto on the right hand side of your screens there, guys. You can click order now; it'll take you just to that link. You can have a look anyway, and if you want to take up that offer, you can do that at any time. So, is there a time when that's going to expire, Terry?
That bundle's going to be active until about Christmas. You can also just go to hotspotting.com, to their website. The homepage is a major presentation of that special offer. There was a time, I don't know what you find with your business, Dennis, but we used to, or at least assume that the Christmas holiday period is probably not a great time to be marketing our products because people are doing other things. But in actual fact, we found quite the opposite. It's actually a very active time for the Hotspotting website in terms of sales of our reports. I think it's because a lot of people are at leisure, and they're quite often holidaying in sexy places like the Gold Coast or the Sunshine Coast or Byron Bay perhaps, and they like to click real estate and have a look, and that's when they have some time to think about and maybe get online and do a bit of research on our website or on yours. And so it's a very active time, we find, for people, particularly as it's the end of the year. They're coming into a new year, so they're probably thinking about what they're going to do with investment-wise in 2020, and it's a good time for us to have these kinds of offers active for people making plans for the new year.
Yeah, look, I've had a few clients last year as well mention that they were jumping on our program because they'd actually find Christmas is a better time because there's less buyers, or less competition, and they're able to get properties probably a little bit cheaper than if there was a lot more people looking. So, I mean, look, I bought my first property over the Christmas period, and I was lucky enough to get a pretty big discount because there was no other buyers really interested. So, Christmas is still a good time to have a look around. I know a lot of lawyers and real estate agents shut down, but most real estate agents these days, they're available anytime. Their mobiles are published readily on all their websites and all their listings. So I'm sure they'll take your call if you're interested in a property. So,
particularly in those areas where people are likely to be holidaying, a lot of them are locations that also have potential to be current or future hotspots. We've talked about the Sunshine Coast as one example, and we talked about new infrastructure coming into the Gold Coast. Many other locations that have growth potential that might be places where people are holidaying. But I also think that this holiday period in particular could be very strong because there's a world of difference between the climate we're in right now and where we were 12 months ago. 12 months ago, negativity and pessimism reigned. Federal election put a dampener on activity and decision making, and now we're beyond all that. We've had 3 interest rate cuts, APRA changes, all sorts of things that are positive for real estate. So I just think that this Christmas, New Year season, we're going to see property investors taking the time when they're not at work, perhaps, to be a lot more active than they would have been 12 months ago.
Yeah, for sure. So look, in saying that as well, Real Estate Investor, we're also doing a last offer as well for the year. So if you are, looking at taking advantage of those reports and then getting an idea of some of the areas that are likely to experience growth, then you can potentially utilize our tools to then try and find properties that are currently on the market to help you secure that. So, as part of Real Estate Investor, you do get access to a few different tools as well as search, but you do also get access to CoreLogic RP data, which is what a lot of the property professionals use and real estate agents use to generate reports. And essentially you're going to get an advantage over a lot of other investors out there in the market. There's on-demand support and help as well to make sure you can utilize the tools. So, for us, from a support point of view, we're open over the right up until Christmas on the 24th, and then we come back right on the 2nd of January. So we're only closed for a week. So there's still support available. You get access to video tutorials, an online support center, access to previous webinars as well. And we've got a lot of videos that are actually based by strategy. So if you are looking at renovations or subdivisions or developments, you can actually watch videos in that context to see how you can utilize those tools effectively. So a bit of training, like I said, we partner with CoreLogic. They run training sessions as well for us. So these are our retail rates. So if you're looking at a month-to-month membership, $149 includes access to RP data. If you're more of looking at a couple of deals a year, you've got 1 year or 2 year options. And you get access to, like I said, Real Estate Investors tools as well as RP data. So this does now bring us to the Q&A session. All right, Terry, got a few questions, Terry. So I'll just go back to the start and see if we can answer a few of these. So Fora has just mentioned that my property has gone down in price due to the oversupply of apartments in Brisbane. My interest-only 5-year period load is up. What should I do? So Fora, look, it's a bit hard to. I might perhaps start off there, Terry. Look, it's probably a bit hard for us to answer because we don't know your personal circumstances.
Yeah, but that's always the underlying factor, isn't it? The answer, 3 people in the same situation or with the same property could have 3 different answers depending on their individual circumstances. But I think one factor that would be common to all is that the reason why values may have fallen in the Brisbane inner city apartment market is because there has been oversupply and vacancies have been very high, but that gradually has been absorbed. So we're now getting very close to the point where vacancies are down to acceptable levels. Still a little bit to go in some of the suburbs in the near city area, but by and large, the inner city apartment market vacancies have now got down to levels where we could start to see some growth again. And Brisbane generally, certainly vacancies were well above 3% in recent years, but now they're down to about 2.5%, and that's trending in the right direction. So if someone has sort of toughed it out for the last 5 years and they've managed to hold on this long, it might be worth holding on a bit longer, because when you're likely to be coming into a period where you might actually see some growth again, it would be a shame to have lasted 5 years of downturn and then sell just when things are starting to turn up again. That would be a general comment I would make about that.
Yeah, look, I could probably add a little bit to that too, because I've got an apartment in the city of Brisbane as well. So not in the city, but about 4 k's out. Similar story. The value of mine went down a couple of years ago, and I did a renovation, and I was still only able to get the same rent that I did prior to the renovation, just because there was so much supply available. But this year I've started to see that turn, and I've been able to put the price up, and there has been a bit more demand for that apartment. So, but the location is going to be key. So I guess with my apartment, it's not brand new. It's actually walking distance to the ferry, to the train, to buses. It's close to the private hospital, and it's right in between the University of Queensland as well as the city. So I've got a lot of things going for it. So I've decided to, I'm not going to sell it just because of the location. And like Terry mentioned, that oversupply issue it's turning. So there's a lot of factors for it, but we don't know obviously everything about that apartment, the area that you're in, and what you're paying. So I think I'm in the same side as Terry in terms of if you can comfortably afford to hold it still, and it's in a good area, it ticks a lot of boxes, then you don't want to sell it and then miss out on all the growth that may be just around the corner. So thank you for that question. Let me just scroll up a bit. So I've got a few people here who can't see the slides. Apologies, guys. Hopefully you'll be able to rewatch those bits in the recording. What was the websites you looked at in terms of infrastructure going ahead? So Tom, you can Google it. So Victoria was, I think it was the big projects or something similar to that. You just type in infrastructure in the state, and you'll be able to find those. They usually come up as the first result in Google. Otherwise, if you're a member of Real Estate Investar, we actually provide all those links next to the actual listing for that suburb. So you can just click on it, and it'll take you straight to the sites. Tom's just asked, do we use Cordell Connect? So Investar doesn't. Terry, do you use Cordell Connect with any of your research?
Not really. We are aware of it. But Cordell's has been around real estate research for as long as I have, and I think it continues to be a good source of that sort of information. But we tend, rather than having one direct source for that kind of thing, we're tapping into a range of sources, including local newspapers around the country, online, looking for announcements, and we file them electronically. We have our own system of sort of collecting that kind of data. So we're getting our alerts in other ways and putting it in neat little packages, and so that when we're ready to do a report on a particular area, it's all there in one of our electronic folders.
All right, excellent. So Farouz just added a little bit more, Terry. So this is in follow-up to the Brisbane apartment question he had earlier. So he's got a $370,000 mortgage, but realestate.com values it at $250,000, and obviously his five-year interest-only loan is up. So probably the first thing I could probably say is don't rely on the realestate.com valuation.
No.
That's just a desktop valuation, and they're not accurate. You really want to jump on and to a site like RP Data or Price Finder or something where you can actually pick comparables, actually look at like for like yourself, and then compare like for like, because that realestate.com value could be based on old units that just sold recently, that's comparable to yours.
Yeah, I mean, those sorts of, we see some of the banks advertising constantly on television that their app can tell you the value of any property. But in actual fact, what they give you is a very broad range, which is not very helpful at all. I think people should be willing to spend a little bit of money on an independent value and get a proper valuation done if all else fails to get a true indication of the market value. It does sound very, very low for an inner city apartment in Brisbane, and it's unlikely to be accurate. So the first thing to do in that person's situation is to get a real a proper valuation done so we have a true indication of what it's worth before making any other decisions, I think.
Yeah, I agree with that completely. Yeah, definitely get an independent valuer, and if you are seriously considering selling, just to actually find out what it's really worth, not base it on a desktop valuation.
Yeah, definitely.
All right, so thank you for that question, and thank you for your comments, Terry. Let's just keep going up. Anna's just asked, Terry, do you have a top 10 New South Wales report?
We have, we're kind of doing two parts. We have a top 5 Sydney hotspots report, and we have a top 5 regional New South Wales report. So they're two separate reports. And if you've got both, they actually exist as a bundle on the website. So you can get the two reports together for less than the price of you would pay if you bought them separately. And so that will probably achieve what you're looking for. Our 5 top picks for Sydney and our top 5 picks for regional New South Wales. And it's worth pointing out that regional New South Wales has been a very strong market. While Sydney was going through its correction, its post-boom correction, and prices were falling down sort of 10% or more according to some of the core logic type data. There are many locations in regional New South Wales that were doing the opposite, which were rising and producing good growth, but they don't get any media. There's this obsession with Sydney and Melbourne, and regional markets tend not to get any airplay. And there's some very good growth markets. Regional Victoria's been great. Regional Tasmania's been fantastic for growth in the last couple of years. And there are specific places around regional New South Wales which have done and continue to do very well.
Fantastic. Thank you, Terry. Hope that's helped, Anna. So just jump on the website and you'll be able to have a look at those. So John's just asked, so what effect on values will the planned Gold Coast M2 have on sleepy suburbs like Jacobs Well and Stapleton? So I'm guessing you're probably talking, John, about the Coomera connector. I think you're talking about that. So look, it depends on where it's going to go through. Obviously, the properties that are going to be right next to that proposed M2 it's probably not going to have a positive effect on it. It'll probably go down if anything. But again, it's going to provide better access. It's going to take a lot of traffic off the M1 for those that are perhaps just travelling from Gold Coast to Coomera or to Stapleton or Jacobs Well. But you're going to have to look at all these other different factors as well. So just because a highway's going through there, if there's no other infrastructure or jobs or anything like that, it's probably not going to have too much of an effect in terms of a positive effect on values in those areas.
Dennis, there was some research some years ago which indicated that when it comes to transport infrastructure, there tends to be 3 phases of growth.
Yep.
The first sort of impact on property values is when like a new motorway is first announced. And then when they actually start building the thing, there's another burst of growth. And then when it's actually finished and people can touch it and feel it and experience the benefit of it, there's another phase of growth. Now, if you buy it the first phase, you get the greatest uplift, but you take the greatest risk because, politicians have a tendency to announce projects, particularly in election campaigns, and then they don't happen or they don't happen anytime soon. So probably the optimum time is when they actually start building a piece of infrastructure like a new motorway. And by that point, the actual route is set in stone. We know exactly where it's going to go and which areas are going to benefit, because right now with some of those proposals, like the alternative to the M1 between Brisbane and the Gold Coast, the actual final route is not yet, I don't think, certain. So it's very hard to be definitive about which areas are going to benefit the most. So it probably does pay to wait till they actually start physically building a thing. Then you can take action, because I think most people wait until it's finished and they can actually touch it and feel it. And so those who benefit the most, probably with the least risk, will be the ones who buy when they start construction.
Great. Thank you, John, for that question. Stephen's just asked, how would you rate SQM research as a source of reliable data?
Look, I like it a lot, and we do use it a lot. That's the SQM research. That's the business of Louis Christopher, who's been around real estate research probably even longer than I have, and he's a very respected figure. He does good work. I think he's a very credible commentator. I like what he does, and you can get really good information from that website. Vacancy rates, for example, it's freely available, and it's reliable information. So it's a useful one to know about. It doesn't give you everything you need, but it's as part of a stable of places that we go to regularly for information we feel we can trust. We rate it very highly.
Yeah, I agree. I personally use SQM for vacancy rates, as well as obviously Investar has, we calculate it as well, and it's pretty much on par. So yeah, I don't use it for anything else but vacancy rates, and the free information is quite powerful, because it does, I think it goes back 10, 15 years, I think, a fair bit anyway, a number of years, so you can actually see the trends.
I've got one of their vacancy rate graphs on the screen, because one of the postcodes you mentioned earlier in the presentation, I put it up, and it goes back to 2005, so it's almost 15 years. So you can very much see trends, as well as telling where vacancy rates currently are. And sometimes I test it out, because they've got vacancy rate charts for every postcode in the country, and I wonder how the hell do they do that? So I sometimes ask people at the coalface, according to SQM research, your vacancy rate is X. Does that make sense to you? And usually the answer is, yeah, that sounds about right from what we're experiencing at the coalface of the market. So I do tend to find them useful and reliable. Yeah.
All right, excellent. Well, it looks like it's come to the end of the questions. So thank you, everyone who's stuck around. I hope that's been informative. And Terry, I really do appreciate you joining us on this webinar. I'm sure a lot of our members definitely have benefited from your insights. So thank you again, Terry, for your time.
You're welcome, Dennis. It's been fun to be part of. I like what Real Estate Investor does. I think at the beginning you said it was important for real estate investors to be data-driven, and you made the comment that there's lots of free data available. And I think people need to be very, very careful about, there's so much free stuff out there, but quite often it's free because it's not worth very much. And mostly what we're getting from media, the free stuff, is telling us, what's happened to median prices in the last 12 months, which tells us, well, we should have bought maybe a year or two ago. But I think really good data is worth paying a little bit for, and I think it's false economy to not be willing to spend a relatively small sum of money, given that what you're ultimately planning to do is spend hundreds of thousands of dollars on a piece of real estate. And if you're not willing to spend a few hundred or a few $1,000s on good quality data to make sure you make good choices, then it's very much false economy, and far too many people make that mistake, I think, and end up with a bad choice of real estate.
Yeah, and I think that's probably why a lot of people are stuck on that one investment property, because the value has gone down and they can't take any equity out, they can't move, and they can't buy their second property. So it can really halt your building your assets for the future. So really, really important, guys, to always do your due diligence and try and take any emotion out of that decision process. So thank you again, everyone. The webinar will be emailed out tomorrow, but if you have any questions at all, or you'd like to take up our offer, so the Real Estate Investor offer there, /special offer, so that'll be available until Sunday night this week. But the Hotspotting Reports Best Buyers Bundle will be available until about Christmas. So thank you again, everyone. I hope you enjoy the rest of your night. If we don't see you on a webinar before Christmas, I hope you have a great break and a happy new year, a very safe one, and I wish you all the very best with your property investing for 2020. All right. Thanks, Terry. Catch you later. Good night, everyone.
Thanks. Thanks to everyone who's listened in.